As always, the views you'll be hearing during today's program are those of the speakers out of Stratford, the speakers' companies, firms, or clients, and are not intended to provide legal or tax advice. We have gathered a panel to furnish tax advisors with a thorough and practical guide to reporting investments in a passive foreign investment company, or PFIC, on IRS Form 8621. The panel will identify those investments that require PFIC reporting, outline the various elections available to taxpayers holding interests in PFICs, and discuss the recent final and proposed regulations affecting PFICs. The panel will provide an example of a completed Form 8621 to illustrate reporting requirements. Our panel today includes Sam Chung, partner at Harlow and Falk. He is joined by Eric Toney, Director, Global Tax Reporting at Expedia Group. At this time, I'll turn things over to you, Sam, to begin today's presentation.
Hi, thanks a lot. Hi, everyone. Welcome, and pleased to be here. My name, as mentioned, is Sam Chung. I'm a tax and law partner with a law firm of Harlow and Falk, which is based in the Tacoma, Seattle, Washington area. In my prior life, I worked for several years in international tax and Big Four accounting. And specifically at the Big Four accounting, kind of cut my teeth on the PFIC world, advising investment funds and high net worth individual investors and other types of taxpayers on the various intricacies and fun with the PFIC rules. And my current practice, I include general business law practice in Washington and California, and also IRS tax remediation and other international tax consulting and compliance. And just to segue over to Eric, Eric actually is a former colleague of mine from the Big Four accounting firm, so I'll turn it over for an introduction to you, Eric.
Yeah, that's right. It's a pleasure to be here, and pleasure to be working again with Sam on these PFIC rules. As he mentioned, this is something that we practiced extensively at Big Four. So about 6 months ago, I moved over to Expedia Group, and while we don't see PFIC situations on a day-to-day basis in the corporate sphere, it certainly does come up occasionally with some of our minority-owned investments. So, yeah, let's get started.
All right. Okay, so we're on the first slide. It's called slide 7, and so you can see a high level what we want to go through with you. One, we understand there might be persons that are not as familiar with PFICs. There might be persons that have dealt with PFICs or had headaches with PFICs. So we have a spectrum. So our intent is to kind of get a wide swath of kind of the universe of PFICs. So we'll have an overview of the PFICs. Then we'll talk about determining PFIC status, also known as PFIC testing. Hopefully we'll walk through some examples that'll hopefully be useful for you to see. We'll show you the kind of different taxing regimes for PFICs. Sometimes you have choices, sometimes you do not, but it's good to know all the rules and what might be eligible for you and or your probably your client. The various filing requirements, and also, as mentioned, recent regulations that are around the world's PFICs. So we're happy to start this. We know that you can't start your summer until you go through a PFIC training, so here we are. And moving on to the next slide 9.
Okay. So the definition of PFIC. So the PFIC code sections are sections 1291 through 1298. And section 1297 gives us the general definition, which is that a PFIC is a company where more than 75% of the income is passive income, or more than 50% of the assets are passive assets. So the PFIC rules are a very mechanical test in terms of whether you are or are not a PFIC. It's fixed based on these bright line thresholds. But as we'll see throughout this presentation, there is a lot of ambiguity and judgment involved in determining whether certain income or certain assets are passive. The asset percentage, as it notes here, is the average percentage of assets. that is typically in the code that is a quarterly average of assets. Many times in practice, that's difficult to obtain. So we will we'll talk more about that.
I'd say one thing to add is, so as Eric mentioned, it's either or, and it's also very important. I'm just going to go back briefly on slide 9. Note that it's 75% or more, and it's also 50% or more. So 50 and 75 is the magic number. That's important to remember, because in other rules, maybe with the Subpart F, it might be greater than 50%, So just remember that if you hit that 50% or the 75%, with the income or the assets, that's when you're in the PFIC world. Okay. So on slide 10, so the basic definition, like how do you get into PFICs? So PFIC is, first, as the definition implies, a passive foreign investment company. So first you have to have passive income of this foreign investment. Now, PFIC is kind of CFC's, or you might have heard of Subpart F, which is another taxing regime. We'll also kind of briefly go through just as an overview. So PFIC is, we've always kind of thought of PFIC as Subpart F's little brother. And one main reason is, as you can see from this definition on 1297, it leverages or piggybacks off of the Subpart F rules, specifically IRC section 954C, which has a definition for foreign personal holding company income, which is relevant for Subpart F rules. So essentially, when you're analyzing these companies for PFIC, you're often going to be looking at these rules under Subpart F and what is considered passive types of income, and whether there might be some exceptions to get you out of that passive classification. That's what that's negative for the PFIC purposes. So you see here, section 954C, it says the term foreign personal holding company income means the portion of the gross income which consists of dividends, interest, royalties, rents, and annuities, all these passive streams of income. Okay, slide 11.
All right. So this slide is meant to illustrate the deferral concept, or rather the anti-deferral concept of PFIC. So the PFIC regime is meant to address two primary concerns. One is the classification of income, and the other is the deferral of income. So in this situation, we illustrate with investment in country Y, and let's assume that country Y has no foreign taxes, that's a low tax jurisdiction, like possibly the Cayman Islands. So if a U.S. investor, whether that's a corporation or a high net worth individual, was to invest in country Y through some sort of a passive investment vehicle, normally they would be taxed annually on any, let's say, dividend income coming from that passive investment. However, in the situation on the right, if the U.S. person instead of investing directly in assets was to form a Cayman Islands corporation as a holding vehicle, and let's further assume this Cayman Islands corporation is not a controlled foreign corporation, then any income coming from that passive investment could essentially grow tax-free. So this was the situation prior to the PFIC rules being enacted, and it's one of the two primary concerns of the PFIC regime.
Right. So essentially, the Cayman company that's depicted here, it could also be known as a blocker company. So in a non-PFIC rule or some other anti-deferral regime rules, this Cayman company would effectively block or defer taxes, for the U.S. shareholder in the company. So, just along that vein, on slide 12, what is the purpose of Congress putting in place the PFIC regime? They wanted to stop this deferral using what Congress referred to as incorporated pocketbooks. And, if you use these holding companies, there's also the possibility of classifying income from dividends to capital gains when you exit on the share of those investments. So, just to kind of hammer it home, prior to PFIC rules, these U.S. investors could have these foreign offshore companies defer their accumulation of earnings and then exit with capital gains. And I just wanted to know one thing you might have noticed if you've turned into one of these Stratford presentations before, is you might notice that our presentation is a little bit different than what you might have seen, where the presenters kind of have two different sections. Eric and I work together intimately with the PFIC regime, so we're essentially kind of weave this together as a collaboration. So we hope that you'll be able to enjoy this. All right, so slide 13, Eric, you want to dig into that?
Sure. So CFC regime, this is kind of my day job that I deal with every day at Expedia. In majority-owned situations where we have U.S. investors that each own at least 10% of a foreign corporation, so those are referred to as U.S. shareholders under Section 958. And if those major investors collectively own more than 50% of the foreign corporation, then we have a controlled foreign corporation. And generally, the income of a CFC is subject to tax under either Subpart F or GILTI. So Subpart F was historically the first of the two rules to apply, and to this day, under the ordering rules, it's still the first level of tax we have to worry about for CFCs. And there's several different types of Subpart F. There's foreign personal holding company income, which is passive income, as we've been talking about. There's also the foreign-based sales and service income that's more operating income. But in any case, for a CFC, any passive earnings are generally taxed immediately as ordinary income under Subpart F. To the extent that income escapes Subpart F, there's also the GILTI rules, which deserve a whole separate presentation by themselves. But in general, it's important to note that the CFC regimes and the PFIC regimes are two completely separate taxing areas. And that's because of something called the CFC-PFIC overlap rule that we'll talk about later in this presentation. The PFIC rule set was, as we mentioned, was passed in 1986 as part of the Tax Reform Act. And it applies to generally to minority-owned investments, 10% or less. It can apply to a 10% or greater shareholder if that corporation is not a CFC for some reason. But we definitely do see situations where both the CFC and PFIC rules can apply to the same foreign company, which occurs if a shareholder owns less than 10% of that PFIC. So we'll be talking about that a lot as well.
Okay, and just one last thing, or one or two last things to add. So just to hammer home, anti-deferral, without these rules, and this is kind of like basic corporate taxation, a U.S. shareholder in a foreign corporation would only pay taxes on their exits in the case of dividend distributions or sale of shares, capital gains. So these are anti-deferral rules that turn off that result. and results in phantom dividend distributions as a high-level summary. So as Eric noted, Subpart F came out during this historical context came out during the Kennedy administration. PFIC came out during the Reagan administration, and then GILTI came out during the Trump administration most recently. Okay. All right, so on slide 14, very kind of intuitive. To be in the PFIC rules, there's got to be a foreign corporation. All right, so part of this, there might be some interaction with foreign entity classification or check-the-box regulations found under Treasury Reg 301.7701, 1 through 4. So they have specific rules for foreign entities. Now, if all the members of this entity that your client is invested in have limited liability, under the check-the-box regulations for U.S. tax purposes, the default classification is a corporation. So if you have some client has an investment somewhere, SARL or something like that, it's important to first understand what is that entity under the foreign law, and then look at how that's classified under the default rules under the U.S. check-the-box regulations. So if it's a default to corporation, that's not that's not always the end answer for PFIC. You can potentially do check-the-box planning, i.e. file a Form 8832 check-the-box election. Now, if you do that on a defaulted foreign corporation, it'll become a flow-through entity if it qualifies. So if there's a single member, it would be a branch. 2 or more, it would be a partnership. But the result of that check-the-box election would be it would no longer be a corporation, and therefore you would not have a PFIC. There's also these entities under the check-the-box regulations known as per se corporations. So it's under 7701-2B8. Now this list, it goes country by country, and it lists companies that are specifically only corporations for IRS purposes and nothing else. If you have a situation like that, that also may not be the end result, for PFIC avoidance purposes. You can sometimes restructure under law, the foreign law, that foreign entity into a checkable entity. So you could do some sort of a reincorporation that might be available under foreign law. So these are just some things to think about to understand. You need to have a foreign corporation to be in PFIC world. Slide 15.
So now we get into some of the attribution rules. And these attribution rules modify some of the basic definitions for PFIC testing purposes and the scope of PFIC testing. So we'll go through these rules a little bit quickly, just because they're very nuanced and they only apply in certain situations, but hopefully this will give you a flavor and a reference point to look into more deeply if you see some of these in practice. So the first rule under 1298A2 Cap A is that if more than 50% of the value of a corporation is owned by another person, then you are considered to own what that corporation owns for PFIC testing purposes. The second rule is that 50% limitation does not apply if the company is a PFIC. So I think in order to illustrate these rules, it's helpful to look at a few diagrams. So here we have 3 diagrams on this slide. The first one on the left, we have a U.S. client owning 10% of foreign corporation number 1, and foreign corporation number 1 owns 40% of foreign corporation number 2. So in general, let's talk about also the middle situation. Now, this is the same situation. The U.S. client owns 10% of the first tier foreign corp, which owns 40% of the second tier foreign corp. The only difference between the situation on the left and the situation in the middle is that the on the left, we have a PFIC as the first tier foreign corp, and on the middle, we do not have a PFIC. So if the first tier foreign corp is a PFIC, then we have to continue looking down the chain to the second tier foreign corp. If that first tier foreign corp is not a PFIC, we do not have to continue looking down the chain. So in practice, what Sam and I typically did at the Big Four firm is, if we were PFIC testing a lot of foreign corporations, we first requested a consolidated set of financial statements so that we could test the parent company and its subsidiaries through the look-through rule that we'll talk about a bit later. And if that consolidated level failed the PFIC test, then we would have to request the subsidiary financials and test all the other corporations in the chain. Also, there's a small note here saying that even if FC1 is a CFC, it can still be a PFIC for this purpose. So this gets at the CFC-PFIC rule, overlap rule, that we'll be talking about in a bit. On the right, we have one more situation which shows exactly 50% ownership. And in that case, because we own 50% or greater, then we would have to test FC2 to see if it's a PFIC. So in some structures, I've certainly seen ownership of exactly 50% of a foreign investment, which generally avoids CFC status. But in that case, we do have to be mindful of potential PFIC status for any lower tier foreign corps.
And just to contrast, so attribution for PFIC rules, now there's attribution rules also for Subpart F purposes and for guilty purposes, and but it's important to note, under the attribution rules under 958 and 318, the general attribution rules, there's some situations where there's constructive ownership. There's no such concept here with the PFIC rules. So, you're not attributing ownership between, like brother or sister, partnerships and things like that, unless it's an actual indirect ownership. Okay, so we're on slide 17. Now this is illustrating there's a very limited U.S. attribution rule. So if you're familiar with PFIC reporting at all, you might be wondering, why would there be a U.S. attribution rule? And the reason why I would ask, why would there be a U.S. attribution rule? Why would you attribute to a U.S. corporation? The U.S. corporation itself is a U.S. shareholder for PFIC purposes. So why do we need such a rule? The U.S. corporation could just report the PFIC and file 8621. Well, the very limited exception for U.S. corporation attribution is sometimes there might be taxpayers, or the IRS is concerned that there might be taxpayers that are playing games to kind of tier out the ownership percentages to get around that 50% attribution rule that Eric just went through. So on the left side, is the general rule. Right, so U.S. owns 100% of U.S. company. There's no attribution. U.S. company would be responsible for any PFIC ramifications, potential tax and 8621 filing. On the right side, this is the limited exception. So it shows, now this is solely for that rule that Eric mentioned, the 50%. If you have this, kind of tiered ownership or diluted ownership between two U.S. persons. Here we've got a client that's an individual, and then they own 100% of this U.S. company. So you see they split out the ownership 25-75, and the intent here was so that the individual would not have to be subject to the PFIC rules. Well, this says, we're not going to regard that for purposes, very limited purposes of that attribution rule. So for that purpose, that individual client is going to be considered to own 100%. And so that person will in fact be subject to the PFIC rules. Okay. Now we're moving into we just covered the kind of overview. Now we're moving into the nitty-gritty of PFIC testing.
Okay. So as we mentioned before, the two tests are the asset test and the income test. So we'll cover the asset test first. Of the two tests, this tends to be the more nuanced of the two. So the asset test is if the average percentage of passive income producing assets exceeds 50% of total assets. So the overall principle of what a passive asset is that it produces passive income under the Subpart F definition. So a couple of things to note are that it's a quarterly average of assets. So a lot of the time in practice, we've seen situations where quarterly financial statements aren't always available, but certainly if you're dealing with a material and a close call for PFIC testing, it's always a good idea to check the quarterly averages. And it's applied on a gross basis, which means that typically we'd be grossing up. If we're using an indirect approach, we'd be grossing up for liabilities. We'll cover that later. And finally, cash is generally considered to be a passive asset. Cash is generally held to not produce operating income. Instead, it can only produce passive interest income. One of the key nuances here is how do we measure our denominator? What is total assets? So there's a few rules here around whether we use the fair market value of assets or the adjusted basis of assets. So in most cases, what Sam and I saw in practice is that fair market value is a lot more favorable, especially if you're dealing with early stage, let's say startup companies. So if the foreign company is publicly traded, then you are required to use fair market value asset testing. So I think the thinking here is that fair market value is generally preferable. And if it's a publicly traded corporation, then that should be just readily available by checking the stock price. However, if the foreign corporation is a controlled foreign corporation and that's not publicly traded, then you are required to use adjusted basis testing. So I suppose the concern here would be that within a closely held structure, there might be ways to manipulate the fair market value. For all other foreign corporations, it's fair market value is the default testing approach, but there is an election to use adjusted basis. If that election is selected, then you later you're supposed to have consent of the commissioner to change that later. So as I mentioned, it's generally more favorable to use fair market value testing, but in some cases that might not be available. So in that case, adjusted basis testing might be an easier approach in practice, but in most cases, fair market value will get you a better answer.
And you might ask, why are CFCs required to use adjusted basis asset testing? It seems somewhat arbitrary. The answer is because the IRS said so, or Congress. So that's just the answer. They require it. On slide 22, so talking about the PFIC testing under both the income test and the asset test is, while there are numerical rules around the 50% or greater or 75% or greater, there's a lot of art that goes into the science, and there's a lot of different fact patterns where you'll have to make judgment calls. So it's an interesting, strange world because having a PFIC is a fact, But to get to that fact, it's there's a lot of gray areas, and just from the context of audit exposure, IRS audit exposure, it's just something to think about as an advisor, because they have all these requirements and these are the rules, but when you come down to it, from substance, you should be asking yourself, is this really a passive foreign investment company, as the original intent of Congress goes? So getting into this world, as I mentioned, the PFIC regime came out in 1986. So you'll see this IRS Notice 8822. Now, we've kind of viewed this as the Bible for PFIC testing guidelines. Essentially, there's been some regulations that have come out, well, more recently, but there's historically been regulations that come out have not been necessarily as descriptive or helpful as this Notice 8822. So if you are involved in advising clients or testing for PFICs, certainly you should take a read through Notice 8822. And so it just goes through different categories of assets, and gives you kind of like the plain vanilla answers, right? So what are some non-passive assets? Fixed assets used in a trade or business, trade or service receivables, intangibles. Now, this is a gray area. So they say it depends on whether the income generated is passive or non-passive. So it's a judgment call, essentially. What is the intangible of the business and what is the business generating? Stocks and securities, passive, unless it's a trader. Cash, as Eric mentioned, passive asset. Now, this has always been a challenge or frustrating, I guess, from a taxpayer perspective, especially for startup companies, because what about working capital? Working capital is going to be part, but the intent is to use it, deploy it for active business, the business's active ventures, right? So there's always been proponents in the tax advisory world to make a working capital exception for passive PFIC purposes. One reference you can look at is the 2010 New York State Bar Association report on PFICs. So they have a strong advocacy for working capital. More recently, 2020 proposed regulations. Now, they give a very limited, but keep in mind, these are proposed regulations, very limited exception for currency in a non-interest-bearing account denominated in functional currency, but not more than reasonable needs of the business. And that's generally described as 90 days of operating cash. So it's a very narrow exception, but it's kind of in the right direction. And so that came out recently, the 2020 proposed regulations. Lastly, just to note on this, as I note on this slide, so if you have a CFC and you're testing it for PFIC status, as mentioned by Eric, adjusted basis is required for the assets testing. This is a favorable rule that might be helpful. It's IRC section 1298E. This allows you to capitalize R&D into your basis for certain research and development expenses. Now, they can't be reimbursed. They're reimbursed, they don't go into your basis. But just keep that in mind if you're dealing with testing CFCs. Slide 23. All right, so I will do this one, Eric. So this is, we put together some examples. So high-level example, this is adjusted basis test. So look at this very simplified balance sheet. And so you have $50 of cash, $30 of fixed assets, $15 of receivables, $20 of intangibles, $5 of other assets. And let's just say that's the company's classification, not ours, right? So total assets is on the books is $120. And then you have $50 of liabilities, $70 of equity. So if I'm looking at their balance sheet, okay, so you've got $50 of cash, then you've got, let's see, intangibles. What did I say from the notice 8822? Depends on what kind of income is generated. Well, what if it's ambiguous? Okay, so one thing we do when we're testing, we call it sensitivity testing. So, and this is from the kind of the tax advisor's perspective. We try to take the most conservative analysis as possible. And so if there's a gray area, like this intangibles, we'll assume it's passive. All right, so let's do that here. And same with the $5 of other assets. So you see that total $75 out of 128 assets. Well, Bing, you're more than 50% or 50% or greater, 62.5%. You've got a PFIC here. Now, is that the end story? Maybe, but it's worth asking your client, or the client, your client could be the shareholder, or it could be an investment fund, but they might have a portfolio company. So it's worth asking the portfolio company, well, what is that intent? What is the nature of business? What kind of income do you generate? What are these other assets? And if you can get more information around those, if you can kick those out, you might be able to get out of PFIC status. So let's say we get comfortable that this company generates sufficient active income so that $20 of intangibles is non-passive. Well, then you've got $55 of passive assets, the cash and other assets, and then suddenly, wow, look at that, 45.8%, and your client does not have the PFIC headache. Eric, do you want to take
Sure.
this next one?
So this next example uses the same facts as the previous example, except in this case we're using a fair market value approach. So typically, to test on fair market value, we would use an indirect method based on the valuation of equity grossed up for liabilities to indirectly measure the fair market value of assets. So in this case, the client owns 10% of the foreign company, and the fair market value of the stock is 15. So what we've seen in many cases is if this is a publicly traded company, it's obviously very easy to value the fair market value. But if this is a more closely held business, what we've seen is clients in the investment fund space use their audited financial statements that mark to market the fund's performance, and they would use those valuations on the audited financial statements as fair market value. Obviously, this is a lot more tricky if we're dealing with a situation where these kind of periodic arm's length valuations aren't required. But in this case, let's assume that we have that. So 10%, if the fair market value is 15 and the client owns 10%, then that values the enterprise at 150, and then grossing up for $50 of liabilities, we have 200 of fair market value. So in that case, regardless of whether these intangibles are or are not passive, we pass the PFIC test in either case. So so we do less work in that case if we can use the fair market value.
Okay. Slide 25, we're looking at the other side of the computation, and keep in mind this is alternative. If you trip up one or the other, it's a PFIC. So income test, 75% or more of gross income is passive from passive sources. Recall that we said it leverages off of 954C, Subpart F, foreign personal holding company income definitions to determine whether it's passive income or potentially if there's an exception. Now, under this, gross income is fundamentally defined by IRC 61, Section 61. Now, this is important because gross income is gross revenues less cost of goods sold. Now, note this note I made. COGS is not the same as OPEX or operating expense. This will become important as we illustrate in our examples. So other items of income, interest, dividends, capital gains. So, when you're looking at an income statement for a foreign company for PFIC testing purposes, you might have the active gross income, the gross revenue. You might have COGS, you might have OPEX, which aren't relevant. And then you'll have other items like bank interest or dividends or capital gains. So generally speaking, those latter ones will be passive. The sub-point also notes interest expense is never COGS, even if it's a financing business. I remember I tried to run that by Washington National, and they were like, "Oh, that's an interesting argument, but conceptually it makes sense." But no, Section 61 is very traditional. It's a classical definition. Your business sells widgets, so it's gross revenues less cost of goods sold.
So in this case, we have a startup company that has 100 of gross profit and 200 of COGS. So as Sam just mentioned, let's assume that this company is actually producing physical inventory property. It also has $1 of interest income. So on a gross income basis, we have this interesting fraction where we have $1 of passive income, but negative $99 of gross income. So there's been two ways to view this that we've seen in practice. One is that all of the gross income is passive income, and therefore having $1 of interest income makes this a PFIC. The other potential view is to rely on a public letter ruling, private letter ruling, 944-7016. And so in this PLR, the taxpayer had a case of negative gross margin, and the ruling stated that made that the negative gross margin, which was greater than the passive interest income, brought the income test down to zero instead of failing the income test. So that that PLR is not necessarily authoritative. However, we have seen clients choose to apply it when PFIC testing.
But also keep in mind, cases where you're going to have negative gross margin are probably few and far between, and they might be kind of anomalous. But you just have to make sure that you're comfortable that those are actually COGS that are in excess of your gross profit. Okay, slide 27, example 2, COGS or OPEX. All right, so here we have $100 of gross profit, $50 of COGS. So gross income of $50, $1 interest income, and $150 of OPEX. And then so your income before tax and your EMP is negative 99. So here, passive income of $1. Total income, including the gross income, is $51. So here, the passive percentage is 2%. So in this case, it's a non-PFIC. So this is just illustrating, oftentimes when you're looking at financials, local country financials, they might jam everything into COGS, and so that might not be a true number. So you just want to make sure, you have to understand what goes into that line item in their income statement. If it's looking more like operating expense, you're going to have to back that out, and it's not going to go into your gross profit computation.
Right. One thing that we saw a lot of challenges with in practice was that in some foreign country financial reporting standards, like especially I think under Chinese GAAP, they don't really have this distinction, this old school distinction between cost of goods sold versus operating income. They just sort of had one line item for cost of operations. So oftentimes we would have to assess the business model and sometimes request further information to make this distinction. So now we get into some of the Subpart F exceptions that apply to the foreign personal holding company rules under 954C. So it's important to note that some of these rules only apply to controlled foreign corporations. It states that directly in Section 954. Other exceptions apply for both Subpart F and for PFIC testing purposes. So we'll be noting that as we go along. The first exception here is for active rents and royalties. So rents and royalties that are part of an active trade or business and that are received from a person other than a related person are not a source of passive income. So this related person, it's important to note that there's a different Subpart F exception, the look-through or same country exception that would apply in those cases. So in order to meet this active rents or royalties rule, there's several different criteria under the reg, which is 954-2. The one that tends to be the most difficult is that the rent or royalty activity has to be managed by the officers or staff of the foreign corporation. So in other words, the foreign corporation needs to have its own employees. We've seen many cases where the structure does not qualify because the foreign company simply doesn't have any employees. In a few cases, you can look to employees of another related entity and not necessarily that same entity. I think that was part of what was clarified under the 2021 regulations. It introduced this concept of a qualified affiliate. But in general, you do need to have employees at that foreign corporation for it to be considered actively managed. The other key requirement is to have a certain level of expenses associated with the rent or royalty activity. In fact, in the regulations, it gives 25% of total income as kind of a safe harbor. But again, that can't be a third-party management company. It does have to be employees of the foreign business.
Okay, on slide 30, topic is microfinance companies. I'll probably go through this more quickly because they're probably kind of a niche, and so we had some of niche in our prior accounting firm practice. But if you have a client that has investments in microfinance companies, essentially they're foreign companies that are, for effective purposes, they're serving the function as a bank, for a local community, but they might not be a formally licensed bank, and certainly not as large as, your bona fide corporation bank. So if you're in this world, or if you have that type of investment, what you need is the active banking exception under 1297 B2A, the B2 Cap A. Now, this is a very strict test. So you see, one thing you have to have is an active bank license under the local country's laws, a bona fide banking business, and a portfolio of deposits. So there are a couple of, kind of guidance or alternatives. One is Notice 8981. There's also regulations on the active banking exception. But essentially, it's going to have to pass a smell test of a bank, have a book of deposits, and also, a lot of customers with that, but number one is the active bank license. Now, in the analog world of Subpart F, foreign person holding company income, there's a more kind of modernized, relaxed definition in this world with 954H, which is the active financing exception to FPHCAI. Now, you don't need to have an active license for that. It's more, it's more just looking at the substance for an active financing business. Do you have employees that are actively within that business, managing the business? Now, one thing to note historically, in 2019, there were proposed regs that would have extended this FPAC, active financing exception for PFIC testing purposes. Unfortunately, in 2021, they rescinded those, clarified that those do not in fact apply for PFIC purposes, except for limited purposes, but you still need to have the banking license. All right, look-through rules. Eric, do you want to?
Sure. So as we mentioned previously, in some cases, well, actually, in most cases, you are allowed to look through to a 25% or greater owned subsidiary. So in this fact pattern, we have a holding company at the top that has limited activities, and then subsidiaries number 1 and 2 that have an active trader business. So if this look-through rule did not apply, it would be quite unfair because that holding company at the top level just owns subsidiary stock and it would test as passive. That would be very unfavorable if the client wanted to sell later. But with the look-through rule, the subsidiary businesses can be considered. So in practice, what we would typically do, as we mentioned, is first request consolidated financial statements and test those. And depending on the result of that, we might have to drill down into subsidiaries. As I mentioned that the 954C exception for look-through rules can apply in some cases. There's also a rule under 1297B2 cap C that says that that's specific to PFIC testing, which says that interest, dividends, or rents and royalties is sourced on a look-through basis in a group of affiliated foreign corps. So what that means is that the mere existence of this intercompany dividend from the subsidiary to the parent, that does not necessarily create passive income for the parent unless the subsidiary itself has passive income.
Okay, so on slide 32, common exceptions. Now, we mentioned this a few times. 1297D is the CFC-PFIC overlap rule. So because Subpart F and PFIC have a different definition, PFIC being based on passive category classification of the company, CFC looking important, where the U.S. shareholder ownership control is important. So you can have both a foreign company via CFC and a PFIC. If that's the case, and you're a U.S. shareholder, i.e., 10% or greater ownership in the foreign corp and the CFC, then you're only subject to the CFC rules, i.e., you'll file 5471 and be subject to Subpart F and guilty. CFC, again, it's 50% more voter value with the significant U.S. shareholders, i.e., 10% or greater blocks of ownership. 1298B2 and B3, so there's limited startup year exceptions and change of business exception. Now, they're kind of, for me, they've been in theory kind of nice exceptions in theory, but we haven't really utilized them much in practice. Might have seen some, footnotes that might have kind of elected them, but we haven't really seen pragmatically where they were useful because, with the startup exception and the change of business exception, essentially it can apply in the startup year or the change of business year, but you have to certify that it's not a PFIC in the 2 successive years. So there's some monitoring to go along with that. And the other thing is once we get into the taxation of PFICs, if you have a QEF PFIC anyways, you could file 8621 for that first year investment, and if it's not going to be a PFIC in subsequent years, then it's a moot point anyways. So, just to note that there, but we haven't really found them to be very useful.
Yeah. My joke is always that the startup exception should be called the Nostradamus exception, because I think it's very rare that you can know with certainty that an investment is not going to test as PFIC the next 2 years. So now we get to common traps. So where have we seen a lot of PFIC issues in practice? The first areas with startup companies, particularly those that are either a sales or service company, really. And this is because cash is considered to be a passive asset. So particularly if you're required to use adjusted basis testing for CFC, a lot of the time an early stage company is not going to have many assets besides cash, and that can cause a PFIC. Also, a manufacturing company with operating losses, this is that negative gross, if you're not able to use that negative gross margin, PLR exception we talked about earlier, that could cause a PFIC. And finally, probably the most common is a pre-revenue company that doesn't have active gross income yet. So, pretty much any early stage biotech company is at a lot of risk, because if they don't have an active revenue stream, but they earn $100 of interest income on their bank deposits, technically that makes them a PFIC. So that's kind of a segue into where we often see PFICs. And now I think
just a brief on slide 34, the slide, it says intentional PFIC. So, this isn't something to spend a lot of time on, but there might be cases where, it might be favorable to see if you can actually affirmatively make your investment a PFIC. And why would that be? Well, if the investment qualifies, if it's a PFIC and it qualifies, or the shareholder qualifies to make the QEF election, which we'll walk through, then the way that that's taxed is essentially the shareholder will get allocations of the actual dividend income and capital gains, net capital gains of that company investment. Now, the latter part is the benefit that I'm talking about. So if that PFIC has capital gains, the shareholder is going to get an allocation of that, and it's going to keep its classification as capital gains, which, as we know, under the current U.S. tax system, has a favorable tax rate as compared to ordinary income. So, it's just a kind of a question. It might be a rare instance where this might be helpful, but there might be cases where you want it to be a PFIC that might result in a better rule, a better tax results. How could you make it a PFIC? Well, if it's under fair market value testing, maybe you can elect to do adjusted basis testing. That might flip the asset test into PFIC world. Also, kind of similarly, if you have overlap between PFIC and CFCs, there might be cases where you want the Subpart F rules to apply. So I don't know. They're just thinking outside the box. There might be things with the shareholder ownership that could be changed that would change the results. So it's always important to think about what are the different tax results on different rules. All right, next section, PFIC taxation. So we're getting into kind of the consequences of having a PFIC.
Right. So now that we've talked about some of the testing rules, what actually does happen if you have a PFIC? Well, broadly, there's three different tax consequences or PFIC regimes, as we typically call them. The first is Section 1291, which is the default. So if you have a PFIC but you do nothing about it, so let's say in year one you had a PFIC, but for whatever reason it wasn't identified, or you chose not to file Form 8621, then that puts you under this 1291 regime, which is also known as the excess distribution regime. So we'll get into the details, but in general, the 1291 is designed to be punitive because the highest rate of tax applies to all excess distributions. In addition, let's say you hold an investment for 10 years and then you have an excess distribution in year 10. That excess distribution is retroactively applied to your entire holding period, and the income is recast into all of those prior years. So that can bring with it interest and potentially even underpayment penalties, depending on how large this is. So Section 1291 is generally not the best answer in most circumstances. So that brings us to option 2, the qualifying electing fund, or QEF. So this is something that the U.S. shareholder needs to elect into. Generally, it's generally best to do so in the first year of your holding period. We'll talk more about that. This is under Section 1293. So this is generally the preferred option for dealing with something that tests the PFIC. Finally, we have the mark-to-market election. This is under Section 1296. And mark-to-market is just like it sounds. You will essentially recognize any unrealized gain or loss within the current year. So let's move on to the next slide and talk about each of these in turn.
Okay, so 1291 excess distribution regime. So this is the nuclear kind of results. Now keep in mind the anti-deferral purpose of PFIC was to kind of turn off parking your earnings in a foreign company and then bring it back long-term as capital gains. So this is the intent of 1291. So you see they're going to tax it at ordinary income rates. Not only that, the highest statutory rates for each year. So historically, back in 2017, you had a 39.6% rate for individuals. Now it's currently 37%. So you're going to take essentially your excess distribution, which is a term of art under the statute, and you're going to allocate that pro rata to the holding period of the U.S. investor and apply for each of those years the highest applicable rates, either for corporations or individuals or what have you. And not only that, you're going to have to pull in the interest and interest charge. So it's essentially the one that you want to avoid as much as possible. Okay, so I mentioned all of this. So what is an excess distribution? So as I mentioned, it's allocated ratably over the holding period. It's treated as ordinary income, right? And dispositions are also treated as excess distributions. Slide 40, what is an excess distribution? So it's looking at the 3 preceding taxable years or shorter if the holding period is less. You want to average the actual distributions for the preceding 3 or less taxable years. To the extent that the current year excess distribution is 100% of that average, you've got yourself excess distribution. So that formula, you can see, it's kind of like a proxy to kind of like if they were actually making distributions year over year, you're not going to have an excess distribution. So that's kind of the mechanical intent behind excess distribution regime. And as I mentioned, capital gain is considered to be excess distribution under the 1291 rules.
Right. So Section 1298B1, this is something that we often call the PFIC taint. And this rule states that once you're a PFIC, you're always a PFIC in all future tax periods, unless something is done to change your status. So again, going back to what if in year 1 of your holding period, the foreign corporation was a PFIC and it was just missed for whatever reason. In that case, that it continues to be a PFIC in all future tax years, which can potentially convert your capital gain into ordinary income. with penalties and interest. So what if we want to get rid of this consequence? If in year 2 or 3, let's say, we discover this and we want to remedy it, one option to do this is the deemed sale election, where the PFIC is treated as sold for fair market value, and all of the 1291 consequences apply, where the gain is treated as an excess distribution, and so forth. Unfortunately, this will create phantom income for your client, where they will get basis credit for whatever inclusion they pick up, but it's just immediate ordinary income. But at least it limits some of the damage moving forward. So deemed sale election, also called a purging election, that's one option.
Okay, so slide 42, this is where you want to be for most cases. This is the qualified electing fund election, the QEF election. So as Eric mentioned, once a PFIC, always a PFIC with an asterisk. So one of the asterisks is the QEF election. So if your client, your U.S. shareholder, finds itself or himself or herself invested in a foreign company that's a PFIC, now if they're able to make this QEF election for the first year of their investment in that company, then essentially what will happen is anti-deferral regime kicks in. So every year over year, well, first of all, you file this election by filing Form 8621 and marking the box for the QEF election. And then, so each year that you're invested in the company and it's a PFIC, you're going to look at the income statement and see what is the earnings and profits of that company, what is the dividends. So you're going to get a pro rata allocation based on your ownership shareholding percentage of the dividends on the income statement, as well as capital gains on the income statement of the company. And you're going to bring that up as fictitious gain as a shareholder. And that's going to, essentially it's going to be reported on your 8621, but it's going to roll up into your tax return, i.e. 1040 for individual, 1120 for corporations, 1065 for partnerships, what have you. So once this happens, anything that's taxed under the QF election is considered to be previously taxed income, or PTI. Now, this is a concept similar to what you have with the GILTI and CFC regime. So essentially, it's just tracking your prior tax, because this is a timing mechanism. You're just accelerating your tax on your investments. So once earnings are actually distributed or you have capital gain, you're going to use that PTI so you're not double taxed. So it's essentially kind of an offset or a credit. Another important thing about this election is you get to maintain character of your capital gains. So I think that's a very big one, given the disparity. You have the 23.8 capital gains with the NII surcharge for capital gains versus your 37% ordinary income. So there's some significant benefit in strategic benefit in making the QEF election. One big requirement for the QEF election is the shareholder must receive a PFIC information statement or have access to companies and books and records. The information must be computed under U.S. tax principles. So this is kind of like a procedural requirement. Essentially, for pragmatic purposes, what it means is the foreign company is going to have to sign off on providing books and records to the U.S. investors so that they can comply with the QF election taxing regime. Essentially, they'll also have to sign a statement agreeing to do so. So that might be an issue in some cases. We've run across issues where potential client issues where the company might have been pre-public or it might have gone public, and their legal advisors got involved and said that would be a restriction on what the company could do to give favorable information to U.S. shareholders versus others. Even though we pointed out you could give it to all the shareholders, but anyways. That might become an issue in certain cases. So that's one procedural hurdle that you have to have in order to benefit from the QEF election.
Right. I think wasn't there one case where we had a client ask you if they could go to jail?
Yeah, that's a good point, Eric. Is a lot of times being a good tax advisor is being able to kind of like simplify and kind of defuse these investment companies or these foreign companies, financial departments of what you're doing, and you have to make it crystal clear. This is for shareholder taxation purposes, and so it's not going to implicate the company or the officers, directors of the company themselves. So that's one part of kind of being a tax advisor.
All right. So the timing of the QEF election. So as we mentioned, it's always preferable to make the QEF election in year one when it's possible to do so. Generally, the QEF election can't be revoked unless the secretary consents to do so. And the election typically has to be made on or before the due date for filing the tax return of the year. So we'll get into a few exceptions where it's possible to file a QEF election later than that. But in general, you do have to do a QEF election year one. That's the default rule. Now, there are some, as we mentioned, it's often kind of unclear whether a company is a PFIC or not. It could even be arguable as to the nature of its income or assets. So there is this ability for the taxpayer to file a statement saying that they reasonably believe that the company was not a passive foreign investment company. So this is known as the QEF protective statement. So some of the requirements for this are that the taxpayer consents to extend the statute of limitations, that the taxpayer files this protective statement, and that the taxpayer has some form of reasonable belief that the foreign corporation was not a PFIC. So this protection statement is kind of interesting because while it does protect the taxpayer's right to make a QEF election later, it's also really a big red flag that there's a potential PFIC issue to be audited. So it's kind of a double-edged sword to file this protective statement. Now, another very important exception is the qualified shareholders exception, or the 2% threshold. So for shareholders that own less than 2% of a PFIC, there's an ability to make a late retroactive QEF election if the company or the company's counsel provides a statement saying that they don't believe that the company is a PFIC. So I think in this case, the Treasury Department was actually being realistic and recognized that PFIC testing is quite a big burden, especially for small investors. So a lot of the times in public company disclosure statements or transaction disclosure statements, there's something buried in there that says the company does not believe that they're a PFIC. So that could be very helpful because it allows these small shareholders to make a late retroactive election if the QEF issue comes up later.
All right. So on slide 45, this is the last taxation regime, the mark-to-market election regime, section 1296. Now, this is limited to foreign companies that are marketable. You're invested in marketable stock, i.e., listed on a recognized public exchange. If that's the case, you can file this election with 8621. Essentially, as the name implies, you're going to be marking to market every year ends your investment in your stock, your pro rata investment in the stock, just based on the public stock price. So, well, let's say one year you have a loss. Well, you're not going to get that loss unless it's to the extent you had mark-to-market inclusions in prior years, which is referred to as unreversed inclusions. So just a simple example, if you had $10 of mark-to-market gain that you reported and paid tax on in year one, and then you had $20 of loss in year two, mark-to-market loss, so the stock just dropped, plummeted, then you would get $10 of loss of the unreversed inclusions that you could recognize for U.S. tax purposes. The other 10 of loss would just disappear. So this is in most cases better than the 1291 regime. It's in most cases not better than the QF election. The main reason it's not better than the QF election is everything that's taxed under mark-to-market election is ordinary income, so you're not going to get any capital gain, unfortunately. But it might be more palatable than the 1291 situation, assuming it's a public company.
Yeah, generally we've only seen mark-to-market as kind of a backup option, particularly in cases where the foreign corporation just refuses to sign that QEF election. So on this slide, we're talking about purging elections, which I already kind of mentioned earlier. So if you somehow discover that there's been a PFIC issue that's been missed in prior years, and you don't have the ability to make a retroactive QEF election, then it's possible to purge the PFIC taint by filing a deemed sale election. This election is made on the Form 8621, and it can be made on either a timely filed return or on an amended return if you're within the statute of limitations. So that's something useful to consider if you're dealing with kind of an issue that's been going on for years. It might consider whether you can file an amended return instead of the current year.
Okay. Filing requirements. So the PFIC reporting form is Form 8621. Now, we opted not to kind of walk through one because there's not much to walk through. So page one, you report the investment information, shareholders information. It also has boxes for elections, the QEF election, purging, mark-to-markets. And then there's sections within that form that may or may not be applicable depending on whether you're a QEF, your mark-to-market, or your 1291. But all the computations you're going to do for purposes of computing any taxes under 1291, for example, being the big one, you're going to do that off the form for the most part, in your work papers. So, you've already essentially done your analysis by the time you're going to the 8621. Some things to note, though, with respect to Form 8621 and who needs to file. 1298F says, unless otherwise provided by the Secretary, each U.S. person who is a shareholder of a PFIC shall file an annual report containing such information as the Secretary may require. Now, there's some exceptions. Indirect shareholders, shareholders through a partnership, for example, they're not required to file unless they have 1291 investment activity. If a partnership files 8621 and reports QEF inclusions or market inclusions, the partner is not required to file. And then there's kind of limited scope 1291 de minimis rules, which look at the total value of all of your 1291 PFICs, and they might allow you to benefit from the de minimis in cases where you don't actually have an excess distribution. The QEF, as I mentioned, the form also provides where you make the QEF fund election and the mark-to-market election. The benefit, let's briefly go back to the once a PFIC, always a PFIC asterisk. If you file a QEF election in a year when you're invested in a PFIC, in year one, let's say in year two, you have that same investment and you test it, and it's not a PFIC. Well, once a PFIC, not always a PFIC. So in that instance, because you qualified for the QEF election in year one when it was a PFIC, year two, it's not a PFIC. Guess what? No 8621. Then let's say year 3, it's a PFIC. Well, yeah, that's 8621 again. So that's another thing to think about as far as filing requirements go.
Yeah, and this, I just also wanted to mention, this is probably the most common question that we received as advisors. When we were on the Big Four side and preparing some of these PFIC footnotes, oftentimes we would get questions from investors saying, well, we had a PFIC last year. What happened to it? We don't see it disclosed as a current year PFIC this year. Well, generally that's because our operative assumption was that any U.S. taxpayers who were paying attention and reading our footnotes were filing that QEF election in year 1. And in year 2, if it doesn't test as a PFIC, then it wouldn't be a PFIC and we wouldn't report it again. However, because we received this question so often, what we started doing was we put in a disclosure of all prior year PFICs as part of our footnotes package. However, that's not an industry standard practice to do that necessarily. We've seen many different advisors prepare PFIC footnotes in different ways. So if you do see one of your prior year PFICs just disappear with no explanation, one option is always to contact the fund, but another possibility might be that it simply didn't test as a PFIC the next year.
Yeah, that jogged my memory, Eric, as far as I remember one of our clients mentioned that another advisor that saw our footnotes essentially referred to our footnotes as the Cadillac of PFIC footnotes.
Right.
So we had a lot of experiences in the trenches with kind of crafting useful information for taxpayers to help them with the PFIC requirements. On slide 48, what happens with failure to file 8621? Now, this is often a question that clients might have, and certainly if they are invested in the CFC and they have to file 5471, each 5471 comes with a statutory $10,000 penalty. So that's, kind of like the stick that the IRS is or Congress is given as far as, compliance to file when it's required. In the case of 8621, there's no statutory penalty, so no $10,000 a pop penalty, but what we kind of like to inform our clients, look at 6501C8. So this is essentially saying for these reporting requirements, and it lists various code sections, often they're international reporting requirements, 1298F being for PFIC. Essentially, if you don't file the 8621 when you're required to, this statute authorizes IRS to keep your statute of limitations open. Now, the question might be, well, does that leave my income tax return statute open, i.e. 1040 or 1120? Maybe, and look at big cat B. So it's a failure due to reasonable cause. If you can establish that your failure to file was due to reasonable cause and not willful neglect, and keep in mind we're talking about the 8621 failure to file, then subparagraph A shall not apply for purposes of your predicate return, essentially. So the statute will remain open on the 8621, but if you have reasonable cause for your failure to file, it's not going to remain open on the 1040. So that's just something to keep in mind. But this is certainly what we advise our clients as far as, if they ask, what happens if we don't file.
Yeah, and generally we did advise them if a prior year issue was discovered, we advised them to file at that point, because at that point there is a good argument for reasonable cause, whereas if the taxpayer just chooses to do nothing, there might not be such a good argument later. All right, and so now the last section of our presentation, we'd like to talk about some of the recent regulations that came out just these last couple years. The first regulation was the December 2020 final regulations. So as Sam mentioned earlier, Notice 8822 was kind of the gold standard or the Bible, if you will, for a lot of PFIC issues for a long time. simply because there were no regulations that were ever finalized for a lot of these issues. So December 2020 regulations were really the first ones that were authoritative, and these regulations were a follow-up and a modification to proposed regulations that were issued in 2019. So we're just, we don't have time to go into detail on every aspect, but just to highlight a few of the things that we saw in practice. The first one being that active financing exception that we talked about earlier. So the active financing exception is critical for microfinance businesses or similar businesses. The proposed regulations had a rule that would have extended it to all foreign corporations for PFIC testing purposes, and not just CFCs. So in the 954H statute, it specifically says this exception is for CFCs. The proposed regulations broadened that to cover a lot of these microfinance exceptions, but then unfortunately the final regulations took that away and said that we should follow the statute and only apply it to CFCs. So that was very unfavorable, and certainly if you have microfinance subs, then that's important to look at. Some other rules are look-through treatment on sale of a subsidiary, and also relief on 958B4 repeal. This is that up and down attribution. We don't have time to go into it, but that was a big issue on the CFC side, and this provided some relief for PFIC.
Yeah, and I'm going to go into it briefly because I made a pretty picture.
Okay.
So on slide 51. So one impact of the Tax Cuts Jobs Act is they repealed 958B4. So 958 generally is attribution rules for controlled foreign corporation purposes. So there used to be a rule that said, if you have this, if you have the structure where there's a U.S. sub here and a foreign sub, for constructive ownership purposes, you don't attribute up and down through a foreign entity. That used to be the rule with 954B. With the Tax Cuts and Jobs Act, they removed 954B4, meaning that IRS could now do this. So what does this mean? If U.S. sub is treated as owning what foreign parent owns F sub. So if constructively U.S. sub owns F sub, all of a sudden F sub is a CFC. What does that mean? For the PFIC rule, you'll recall CFC means adjusted basis assets testing. So this kind of gave us a conniption fit when it first came out. But there were some notices and regulations came out that clarified, as Eric mentioned with the final regulations, for purposes of PFIC testing with the assets test, don't do this 958B4. So it's still going to be fair market value if it otherwise was.
Okay. And now we get to the recent bombshell that happened just this year. And so this has to do with the final Section 958 regulations and the treatment of domestic partnerships and S corporations. So for people who deal mainly with corporate tax, we're all very familiar with the Subpart F and the GILTI rules, and those were dramatically changed by TCJA with respect to domestic partnerships and S corps. So historically, a domestic partnership was considered a U.S. shareholder for 958, and that means that if it owned more than 10% of a CFC, you could pick up Subpart F income and pass that on to the partners of that partnership, even if those partnerships owned much less than 10% indirectly via the partnership. So that was the approach for a long time, and it made it more favorable in a lot of cases to use a foreign partnership instead of a domestic partnership, just to avoid this rule. So then, something that was a bit surprising at the time is that the final GILTI regulations came out and said that a domestic partnership should be treated as a foreign partnership for this purpose. In other words, aggregate instead of entity theory in subchapter K terms. So with this change, that alleviated the Subpart F and GILTI burden for some of these domestic holding companies. Now, when we think about the PFIC world, we have this CFC-PFIC overlap rule, where generally you're not a PFIC shareholder if you are a 958 shareholder, a greater than 10% shareholder. But now that rule no longer makes sense for a domestic partnership or S corporation, because they might not be picking up Subpart F or GILTI income, and at the same time they're arguably escaping PFIC consequences under this overlap rule. So this was an area of I know that we debated sometimes whether this overlap rule applies, whether it really should apply. So the final the final 958 regulations essentially confirm aggregate theory for GILTI and Subpart F, and then along with those regulations, the Treasury released proposed regulations that deal with PFICs. So under these proposed regulations, a domestic partnership is no longer considered to be the U.S. shareholder for PFIC for PFIC ownership purposes.
And that includes S corps.
Yeah, S corps as well. So either of these flow-through vehicles, as we were saying earlier, generally if it's a U.S. flow-through vehicle, the U.S. partnership or S corp would be the one filing the QEF election and dealing with all of that compliance burden on behalf of the partners. However, these proposed regulations would shift that burden from the partnership onto the partners. And then the domestic partnership would have to provide a footnote disclosure, or perhaps a Schedule K2 or K3 disclosure to allow the partners to make QEF elections. And that puts a big compliance burden on the partners, and also a big risk that the partners won't be aware of it and they'll miss their QEF elections. So again, these are just proposed regulations at this stage. It's not a done deal yet. And Sam, I believe you forwarded me something that the Treasury Department was considering some relief.
Right. So as Eric mentioned, these proposed regs would have the actual underlying individuals make the various QF market elections. However, and there's transitional relief, of course. However, a Treasury official was interviewed recently and said that they were considering making alterations to the proposed regs, essentially to allow, in certain cases, individuals to continue to make these elections. So they're looking for kind of a pragmatic, fair approach. And then lastly, we just showed you Schedule K3 here. K2 and K3 are kind of like the big behemoth monsters that came out with the IRS post-Tax Cuts Job Act. Now, this is a Schedule K2, K3 to partnership returns. Now, prior to this, there would just be the Schedule K1, and then, as Eric mentioned, there'd be footnotes, which would include PFIC information for U.S. shareholders that were partners. Well, now there's these K2, K3s, which actually have areas to specify PFIC information. So it's kind of like put footnotes into the K2, K3 worlds. And with that, I see our time is up and we're through our slides. So believe we're going to move to Q&A soon.
All right. Thank you, Sam and Eric, for your insights today. Before starting to address your questions, let me remind our audience that you must remain on the webinar throughout the Q&A session in order to earn full CPE credits for this program. Now, on to our live question and answer session. Listeners can ask our speakers any questions relevant to today's topic You may email questions to taxpreparer@stratfordpub.com or submit questions by typing your question into the Q&A box at the bottom of the screen and hitting enter. Our first question, if a taxpayer filed Form 8621 for a specific entity that it received information through Schedule K1, if the following year's K1 does not have any info about that entity, is the taxpayer required to still have the Form 8621 for that entity along with their tax return? If so, how many years should they continue to have it in the return? And what if the pass-through entity never sends any info about that entity in subsequent years?
All right, good question. So essentially, as Eric had mentioned, obviously the footnotes you get will depend on who prepared the footnotes, but as the tax advisor, you can certainly ask the investment funds for follow-on information to confirm if you're not getting any confirmation from the footnotes. But let's say that you had a K1 footnote for year one that had a PFIC, and so you filed 8621 and you made an 86 QEF election. And then year two, you got a footnote package from the investment fund, and there was no information on that specific investment. So if I got that, that fact pattern, I would assume that the fund was still invested in that company, but it was not a PFIC, or potentially it might have divested of that investment. But certainly, if you timely file a QEF election based on the initial footnote, and you don't have any information, a reasonable conclusion is that there's no PFIC. But to be ultra conservative, you can kind of ask a specific confirmation question, which the advisors always love to get from their clients. I think that, is there anything you want to add on that?
No, I agree with all of that. And yeah, as I mentioned earlier, this is the number one most common question that we would get as advisors. And so, yeah, I also recall that every time we prepared these, we would always include consult your tax advisor in there somewhere. So yeah, I would certainly encourage you to consult your tax advisor if you're really not sure about what happened to a particular investment.
All right, next question. When is Form 8621 to be filed in the case of Australian superannuation reporting?
All right. So I think this is a great question, and I actually confess that I had to Google this one while the presentation was going, because I haven't dealt with this type of entity in practice. But I think it would be helpful to go through it from just a kind of a first principles approach. So when we're dealing with a foreign business entity, under the 7701 regulations, there's really three possibilities. One is that we have a foreign entity that's treated as a partnership. The other is that it's treated as a corporation, or the third possibility is that it's treated as a foreign trust under 7701-4. And so the foreign trust, so this Australian superannuation fund, if I understand correctly, it's essentially something that's similar to a foreign pension fund, I believe. And so have you actually seen these, or?
Well, it's a good question, and it's a sticky area. But that analysis is sound, Eric. But essentially, the Australian supers, and then I think also, some similar variants like the New Zealand Kiwis, the Kiwi Savers. It's hard to put them in boxes, and the IRS guidance is kind of like ambiguous, maybe even contradictory. So I think there isn't any general consensus in the U.S. tax advisory community as far as what to do with these from a U.S. reporting perspective. If they're foreign trusts, then they go on to the 3520-A. I think, for my personal practice, we advise to report most conservatively as trusts on the 3520s. Probably might be redundant in that instance to do a 8621 if you're asserting that, conservatively speaking, that it's a trust rather than a corporation. But I guess the short answer is that it's a gray area. Unfortunately, I'm not aware that the IRS has given definitive guidance out there. I think there's been FOIA requests on IRS kind of internal documentation and emails, and there might have been some that gave kind of views from certain IRS examiners, but I don't think they've given any kind of public view other than certain rulings and revenue procedures, more specifically on, for example, Canada retirement funds. They have some more specific guidance there. So I'd say in some most conservatively, with Australia, at least from my perspective, I recommend reporting as a trust to my clients.
Okay. And so the key distinction between a trust or a business entity, I suppose, I think that would mainly be looking to whether it's merely an instrument for preservation of value that would kind of, or management on behalf of another person, that would kind of be a trust versus if something has an actual business operation, that would typically be considered a business entity. So either a corporate partnership. Would you agree with that, Sam?
Yes.
Okay.
All right, our next question goes back to slide 14. What if you own or are a beneficiary in a foreign trust considering less than 10%, more than 10%, less than 50%, or more than 50%? How does the PFIC status apply?
Well, I think it's, this is similar to our prior, most recent question and conversation. First, you have to understand or take a view on what that foreign entity is. Is it a trust? Is it a corporation? Once you reach that conclusion with you and your clients, if it's a trust, then 3520, conservatively speking. If you're leaning towards corporation, then you would default to, is it a controlled forward corporation? If they have 10% or greater, then the overlap rule would lean towards them filing 5471 as a U.S. shareholder. If less than 10%, then 8621.
All right, on to the next question. Rather lengthy. I'll read it slow so everybody can follow along. Over many years, we've observed that on the U.S. domestic partnership K-1s we receive, a specific PFIC may be reported in 1 or 2 successive years, but then is no longer reported in subsequent years, possibly because the amounts have become de minimis or the investment was sold. Where a definitive sale of the PFIC has not been reported on the K-1 because we're then uncertain whether the PFIC is still owned, we're compelled to include a Form 8621 for the non-reporting PFIC in the taxpayer's tax return to avoid the potential foreign reporting penalties. As the taxpayer's partnership investments continue, the number of Form 8621 disclosures continues to increase. The tax preparer, Deloitte, has stated that each year they believe they've provided the taxpayer with all necessary information. How do we ensure accurate PFIC reporting but not over-report?
Right, and I would hazard a guess that this situation is very similar to the one we talked about earlier, where the preparing firm, in this case Deloitte, would have been doing an annual PFIC test on behalf of this fund, and to the extent that they concluded that a certain investment is no longer tests as a PFIC in the current year, the assumption would have been that all of the investors would have made a QEF election in those prior years, and that QEF election in the prior year would have purged the PFIC taint, so there's no longer this 8621 filing requirement. So in order to address this situation, I would first look to whether a QEF election was filed in those prior years. So if the 8621s that were filed in the prior years had checked the box for a QEF election, then that means that we have a QEF election in place. If they did not check the box for a QEF election, then we would be under the default rules, the 1291 rules. And under the 1291 rules, there actually is not an annual filing requirement every single year for that PFIC, but there would be a filing requirement in any year where a distribution or an excess distribution was received. So that filing requirement potentially could trigger to penalties and interest. So I certainly understand the approach that was taken here to continue filing Forms 8621 protectively to avoid some of these potential issues. But in this case, they might not have been required. So hopefully it's possible to confirm with the fund what happened to some of these prior year PFICs that are no longer reported, whether they were disposed or whether they simply stopped testing as PFIC. That might be one way to deal with that situation.
Yeah, and then one other thing that we did in our practice was, if we thought there were shareholders that didn't make a QEF election, we would add in something in the footnote like, if you require further information, contact the fund.
If U.S. Corp A owns 100% of an FC and the FC owns 100% of U.S. Corp B, when we run the PFIC test, should we include the assets for U.S. Corp B?
This is a great question, and under 1297C, I believe that our slide said if we have a foreign corporation. However, this statute actually says another corporation. So I believe that domestic corporation would tier up as well. I didn't have time to double check in the regulations, but would you agree with that, Sam?
Yeah, I believe that's the general rule. There might be some narrow exceptions under recent regulations, but I don't recall offhand. So I think, generally speaking, the rule would include the foreign sub. Although interesting kind of fact pattern, to note, probably not your problem, but that U.S. sub corp would probably have another filing requirement with 5472. Being a foreign-owned U.S. company.
Next question, are Saudi public equity mutual funds, PFICs, several are very large and are part of the government, such as the Public Investment Fund of Saudi Arabia?
Right, and getting back to our classification, so I've never dealt with this and for a client fact pattern. Looking under the 7701 regulations, so again, I think you'd be looking at whether this is a trust or a business entity, and if it is considered to be a business entity, then I would think that it is a corporation. So there is under 301.7701-2B6, it says that a business entity wholly owned by a state or other political subdivision, that's regarded as a corporation. So yeah, I'm not aware of this one. Have you ever seen this Saudi fund or similar?
No, it seems like there's a couple of questions on different country funds. There isn't any kind of as a general rule, there isn't any uniform guidance. So certainly you can consult with different advisors to see if they can give you some kind of affirmative perspective and the reasons behind it. And certainly if you'd like to reach out to me, we can have an offline conversation as well. But I don't think there's any kind of, as a general rule, when you've got these kind of retirement funds or pensions, it's hard to have kind of black and white answers. We can always give kind of like conservative recommendations as far as, penalty avoidance, for example.
Okay, we have a person who would like you to comment on UK SIPs, and are they subject to PFIC reporting? Also, are they exempt from 3520 reporting under Revenue Procedure 2020-17?
So I think along with my last comment, I haven't specifically dealt with that, but, certainly, it would depend on what that guidance provided. If it's something that you needed to get a second set of eyes on, certainly, feel free to reach out to me.
All right, we have time for one more question. A U.S. partnership owns less than 10% interest in a foreign corp, which is a holding company that owns 100% of a subsidiary that presumably meets the qualifying insurance company or QIC exception. You mentioned the common look-through rule, which I'm assuming allows the foreign corp to also be treated as meeting QIC status, and therefore the U.S. partnership and its partners are not deemed to own a PFIC?
So in general, when we're doing this look-through testing, if that foreign operating company meets some of these exceptions, like active rents or royalties, qualifying insurance company in this case, the financing income in another case, generally then the income would be active, and that active status would tier up when we're doing a consolidated level test. Now, I would caution that I always like to just double check these things in the relevant regulations just to make sure. And I haven't had a moment to do that on this QIC question. But in general, I would say that my guess is that it will qualify as active because the general way we look at this is to look at the subsidiary's activity and then tier that up the chain.
All right, we are unfortunately out of time. So again, thank you, Sam and Eric. To our audience, we thank you as well. We hope you have enjoyed our national webinar, Form 8621, PFIC Reporting, Passive Foreign Investment Company Rules. If your question was not answered, you may email it directly to our presenters. Their email addresses are included in the presentation materials. An evaluation and attendance attestation form will be emailed to attendees within 24 hours. Please take a moment to fill out and submit the form to let us know how we did today. Again, for those of you seeking standard tax or accounting continuing education credits, you will need to have responded to all of the pop-up prompts. Today's participants can order a recorded version of this event at a special attendee price. Please call customer service at 800-926-7926, extension 1, or visit Stratford's website at www.stratfordpub.com. If you're not yet a Stratford Annual Pass holder, try the CPE Individual Annual Pass. You can get all your CPE credits for one low price. Simply respond to the email you will receive after the program. Again, thanks very much for being with us today. Panelists, if you'll please stand by. Listeners, to end this webinar, simply close your browser. Again, we thank you and have a great rest of your day.